Going into Monday morning, I suspect it's going to be the resilience of this strong dollar, in all honesty. Even just looking now over my shoulder at what's going on since the release of a soft CPI print, the market is not, it's going to price in some rate cuts from the Fed with more enthusiasm at the margin than before. We don't know much more than we did, but we'll price a little bit more enthusiastically on easing. And I'm not seeing the dollar backing off very much at all on that. Because and it's sorry.
No, continue, please.
I was going to say, because the CPI numbers don't tell us anything new about growth, and that's where the real debate about the U.S. economy is going to happen.
What you're so good at, Kit, is there a bet in the market right now?
I think the market's betting on rate cuts, but it's also betting on resilient growth. That keeps me confused. And I should add, this is the most dollar-centric, U.S.-centric economic cycle that I can remember in ages, because the uncertainty around the U.S. GDP numbers, retail sales numbers, consumer price numbers is much bigger than the uncertainty about the lack of growth in Europe or in Asia. So it's all about you guys, and we're getting no information. So when we get some, we think the labor market's weakening, but not knowing more, we're I think collectively assuming that we shouldn't be revising down GDP forecasts. So that there's lots of productivity, there's lots of AI, there's lots of good things. The equity market's still strong. So U.S. exceptionalism is still in place. That bet is there. Today's soft CPI prints will encourage rate cuts, but they won't change that optimism about the economy, is my bet.
And Kit, it's interesting for me at least to hear you say it's still all about the U.S. exceptionalism, because the trade has been that it's kind of about you guys over in Europe. I mean, you're starting to spend some money on defense and your infrastructure, and you can't really depend upon the U.S. to the extent that you did before. How do you think about that dynamic? Because we do have the euro again out at 116 here.
Well, the euro popped up to 116 on a move down in U.S. rate expectations that narrowed the gap significantly, and on some optimism in growth. Obviously, the fiscal problems in France haven't helped on that.
That's true.
And equally, that there's not a huge amount of there's hope. But if we look at the exceptional spending that the Germans were getting ready to unleash, it's not happening fast enough. So you see the real performers in Europe are the people that can be more fleet of foot. The Swedish krona has been doing very well because they have a bigger arms industry relative to their economy, but they also are pushing forwards. The Norwegian kroner is doing really well. The euro is lagging those, and the Swiss franc is doing as well as the euro is.
Yeah.
Speaks volumes about safe havens.
That's right where I wanted to go. Audrey Child-Freeman with Bloomberg at Queen Victoria Street. Kit was just brilliant yesterday on analyzing Swiss franc. I mean, I guess it's out of the purview of many of our listeners and viewers. Explain the ramifications for America, for Zurich, for Geneva, if the Swiss franc breaks to new strength.
I think it causes, I think people will then turn around and see much more clearly that there's money chasing havens, that the money that we see enthusiastically going to gold, because we quite like that story, that actually this is a world where people want to put their money somewhere safe in a vault deep underneath the Alps. That's not animal spirits in the sense that we know and understand them. So it tells people that although the U.S. economy is dominant, people aren't really confident in the dollar.
Yeah.
And they're not confident in the euro, and they're not confident in the yen. And hey presto, we don't mind if the rates are zero. We're coming to Switzerland.